जी बिस्मिल्लाहिर्रहमानिर्रहीम अस्सलाम वालेकुम एंड वेलकम बैक टू माय चैनल लर्न एंड ग्रो विद फराज। As you know, this video series will be included in the playlist of business finance. And I am making a series of videos on the subject of business finance. So if you are a student of BBA, MBA, BCom, MCom, ACCA, or if you are student of accountancy or business studies, then these videos will be very helpful for you. Okay. So without casting any delay, let's go to our next video. I will suggest you, if you have not watched the previous videos, you should go to the playlist, and from there you should watch the previous videos so that your concepts would be clarified. Okay, now today we are going to study about DuPont identity. DuPont identity, basically this is the name is given because of the DuPont Corporation, which is a corporation uh, which actually devised its name, and it gave a formula for calculating the return on equity, ROE. The popular expression breaking ROE into three parts. DuPont identity, this equation or this formula actually breaks down the return on equity into three parts, which are operating efficiency. Operating efficiency means how much successfully you are uh, moving in the operations and how much profit you are earning from your operations. Then asset use efficiency. Actually, it is asset use efficiency talks about the turnover from the assets. And financial leverage basis on the equity and equity multiplier. We will discuss these things in the coming video. The operating efficiency is measured by profit margin, as I told you. Asset use efficiency measured by total asset turnover. Total asset turnover means how much income, how much profit you have generated from your assets. And leverage as multiplied by the measured by the equity multiplier. Now let's move to the formula of return on equity. The formula for return on equity is, as overall formula is net income divided by total equity. This is a comprehensive formula. I have erased it for you, and I am going to explain you an easy formula for this concept, which is return on equity is equal to net income divided by sales, and then you have to multiply with revenue divided by total assets, and you have to multiply it by total assets divided by shareholder equity. You will be having the net income, the sales, the revenue, or the amount of total assets, or the amount of shareholder equity, and you have to put that amount, put those figures into this formula, and from there you will calculate your return on equity. Okay, let's move forward. We have done now is to partition of ROA. ROA is basically return on, this was return on equity, and ROA is return on assets into two components or two parts. First one is profit margin and second one is total asset turnover. The last expression of the preceding equation is called DuPont identity, after DuPont Corporation, which is popularized its use. As I told you, the name of the DuPont identity is because of the DuPont Corporation. Then the next topic for our discussion, today's discussion, is using financial statement information. How we use financial state information from the financial statement, and what is our purpose for using those information. First one is time trend analysis. In time trend analysis, what we are going to do, we actually looks the same ratio, for example, profitability ratio or the liquidity ratios. So we see those ratios again and again for a number of years. For example, we can see the profitability ratio of XYZ company in 2023, then in 2024, then again in 2025. So we are actually looking at the ratios, same ratios over and over again in time trend analysis. Then peer group analysis. In peer group analysis, what we do, we analyze the similar companies which are similar in their profit or in their manufacturing, or which are producing similar products to our company. We actually compare our ratios with those similar corporations in the same industry. And we check their SIC code. SIC code means Standard Industrial Classification, in order to make sure that we are comparing our company with the similar operations holding companies. Then inappropriate peers. This is some companies operate in several industries and have different accounting standards. There are many companies which are operating in more than you can say one department. For example, a company is making dealing in pharmaceutical sector. The same company might be dealing with the uh, tires and tube manufacturing, and same company might be involved in manufacturing leather shoes. So these are inappropriate peers which are not actually working in the same standards and same type of industries. Then aspirant analysis. You may want to compare your firm with the best in the industry or choose similar firms which are at the top of the industry. What we do in aspirant analysis, we actually select one of the best company in our which is related to our business or which is related to our industry. So we select that best industry and then we compare our ratios with her ratios in order to gain a better understanding about the performance of our company. Then sources of information. Financial websites, for example, Yahoo Finance, Reuters, FT.com. These are all the sources of financial information from where you can get the financial statements of the various companies from these said sources. So companies' accounts can be downloaded from their website. Most of the companies, especially the well-known companies, they upload their company accounts on these websites so that you can uh, you can get their accounts from them, and then you can compare it with your company. Then our last topic for today's discussion is the problems with the financial statement analysis. What are the underlying problems which encounter during the financial statement analysis? It says there is no underlying theory to help us identify which quantities to look at or guide us in establishing benchmarks. It's saying there is no literature available or there is not a general rule that we should compare which quantities or which ratios. We have number of ratios, as I told you in the previous lectures. So there is not a pet rule or there is not a benchmark. There is not a standard that these ratios should always be measured and should always be analyzed. So this is one of the problem in the financial statement analysis. Then there is not much help in terms of financial guidance for making judgments about the value and risk. For example, we can't say which ratios matter the most. This is also another problem with financial statement analysis, that we cannot say that the profitability ratios, they are more important as compared to liquidity ratio or as compared to asset turnover ratio. Which ratio is most important? This differs from company to company. For some companies, profitability ratio should be on the top level. For some companies, asset turnover ratio should be on the top level. So there is this can also be a problem because there is not a fixed ratio which is valuable always for every company. And there is a difference of value and risk associated with each financial ratio. Okay, every financial ratio is bound to have its own risks and its own value. Then differences between financial statement outside of Europe makes it hard to compare financial statement with the companies that are across national borders. So this book is basically based on these notes are based on the book of European writer, and in European countries, the standards of companies or the rules of the companies, they might differ as compared to the outside world. So this can also be a problem if a company is running in Pakistan and you want to compare it with the company in the Europe, then definitely there is difference of standards, difference of rules, there is a difference of economy and culture. So these differences create the problem for the comparison. Then different firms use different accounting procedures. Some firms, they end up their year on December 31. Some firms, they end their financial year in the June 30th. So accounting procedures are also different for different firms and different companies. So it can be a problem for the financial statement analysis. The next point, different firms end their fiscal years at different times. As I told you, fiscal years mean the financial year of a company. Most of the companies, they complete their fiscal year in on the 31st of December, and there are various companies which complete their fiscal year in other months of the year. So this difference leads to the problems in the financial statement analysis. Then firms in the seasonal business will have difficulty comparing statement because of fluctuations throughout the year. Some firms, they are involved in seasonal business. For example, in the winter season, the demand for warm clothes goes higher, and in summer season, the demand for you can say silk, or demand for thin clothes goes higher. So it also creates a difficulty for comparison purpose. And sometimes what happens, if there are winters in Pakistan, there may be summer in the USA. So the difference in the seasons, they also create a problem. And the seasonal businesses, sometimes different firms have their own seasonal businesses. This create a problem for the financial statement analysis. So inshallah, in the next video, we will be covering lecture number 3, financial planning. But for now, I will complete my video here. And in the end, I would like to once again request you to please subscribe my channel. If you have not subscribed it before, it will going to be very helpful for you. Thank you for coming to my channel. Stay blessed, stay happy. Fi Amanillah.